Next guest
Thanks.
says the Fed, because of the big 50 basis point rate cut, is now ahead of the curve, and it's keeping stocks and bonds in their trading ranges. And with global central banks continuing to ease, there's more tailwinds. Let's talk to Brian Weinstein now. He's head of global markets at Stanley Investment Management. And Brian, let me just cut to the chase here on China, which in some ways is maybe a leading indicator for this whole conversation. Are you a believer in that story or a skeptic?
You know, I've been a believer that China would start to really ease into next year. Obviously, they got ahead of the curve. But I think what you see today is that they're not going to do it all at once. So with the Fed easing, with a lot of other central banks easing, I think China has a longer-term oversupply of housing issue and some other structural issues. They want to ease. They're not going to fire all their bullets at once. But I do think you will see a cyclical China recovery into next year. These 10% daily moves are a little bit harder to figure out what each little piece means. But obviously, China is watching. They're on the ball. They're not going to do it all at once, and they're going to get some tailwinds from the Fed and other central banks.
Yeah, and if you're right about that, it's going to help GDP on the margin, maybe also be a little bit inflationary as well on the margin, which is something to keep an eye on. What are you doing in terms of overall positioning right now? The fact that after they cut rates, the long end has moved higher.
Listen, I've been of the view, as you know, that rates have kind of found their bottom. They're ahead of where they should be. If the 2-10s curve is going to end up at 150 or 200 basis points as per normal, and neutral is somewhere between 3 and 4, when you get 10s down towards 360, it's hard to rally them more. And I think what's really interesting is moving credit spread. So we backed up a quick 30 basis points, and credit spreads didn't widen. So there's demand for fixed income. There's demand for risk. That is good. It's good for the Fed. It means they can now ease a bit more slowly. I think you'll see tighter credit spreads. I think you will see higher rates, maybe meaningfully higher rates, but it's going to take a little while to work through the demand for fixed income.
So you're not really ruling out that we go, not even that we stay above 4% on the 10-year, but that we go to 4.5 or 5?
Listen, I think if you ask me for an aggressive range for the next year, I would say that 350, 60, where we saw a week and a half ago. Yeah, I would say you break the old highs. Like, let's make it a wide range. I would say you can get to 5 or even 5.5.
Wow. If
terminal is 4. 5.5 is a very reasonable thing. Listen, what's amazing, Kelly, is when 10-year notes got to 5 with the Fed at 5.5, the economy didn't crater. Everyone thought it would. So there's some resilience to this economy. A giant fiscal deficit helps, and I think you'll get some more stimulus once we're through the election. So there's a lot going on, and I don't think the economy ever got as weak as people expected it to, given where the Fed went, and that's important to note.
What is the Fed doing in a 5.5% 10-year scenario? I assume at that point they're not cutting more, although maybe they are. Would they be hiking rates?
Yeah, it's interesting to think about, right? People will say, well, more QE. Listen, I don't think they're going to lose control of rates, but I do think there's still this positive correlation between stocks and bonds. With at the lows in interest rates, we were basically at the highs in equity. I think you can assume at a 5.5 10-year note, if we got there, equities would be lower. It would start to hurt. So the Fed would have to do something or consider expanding their balance sheet again, stop first, maybe you have to stop shrinking it. But it would be interesting, depending on what inflation is doing, if they would ease or tighten. It's hard to say exactly, but certainly I think we're going to go to that pain point where yields put pressure on stocks. We're nowhere close, but that's a 2025 story.
I'm starting to come around to the Barry Knapp view that the Fed should start aggressively selling securities from its balance sheet, because why not? Obviously, I forget which Fed official themselves this week said, no, we're not going back to the balance sheet the size it was before all this, and that's fine. But why not at least move aggressively in that direction instead of moving rates?
It's hard to shrink the balance sheet without being disruptive. I agree. Being aggressive has some merits because it gives you a chance to increase it later. But it's disruptive. So time is on their side until it's not. You've also seen some repo issues, right? So it's not a free option to continue to let the balance sheet shrink. Someone has to take up that slack. And into year end, I think we'll see some funding pressures. So it's a complicated story, but listen, the balance sheet's a tool. They'll use it, and they will try to shrink the balance sheet as much as they can until they have to use it again. And I could be wrong. Maybe they won't have to, but I think it's out there in the ether somewhere.
Yeah, it just seems kind of strange that we're stuck here with a, whatever it is, $7 trillion balance sheet. The economy's so good, but we can't possibly sell that down because the economy, the financial system isn't strong enough. That all just seems such an odd state of affairs.
It is an odd state of affairs. Again, no one thought we'd get here. It's hard to get out of. It's a big number, $7 trillion. It's not easy to unwind that, and I don't think they ever will, as the Fed says. Yeah. Listen, they want to get out of mortgages, so they'll do that. But I think the Treasury piece is important. The system is very large, and the extra liquidity is still needed.
All right,
Believe it or
Brian.
not.
Thank you. Appreciate your time this afternoon. Brian Weinstein.